Ripple's Asia venture looks to make XRP a yield-bearing asset. What is this going to mean for XRP holders? We also have an update from Japan, what's happening, and what could the price of XRP be if XRP really stepped in to help this liquidity crisis. I got all of that information in this video. Let's start here from Taro Kimono. Organizing the XRP ledger utilization concept by SBI Ripple Asia and Doppler Finance. SBI Ripple Asia has reportedly signed a memorandum of understanding with Doppler Finance to explore yield generation mechanisms and real-world asset tokenization using the native protocols of the XRP ledger. This initiative can be interpreted as SBI Asia's full-scale engagement with the XRP ledger's native functionalities, marking a strategic shift in how XRP is positioned. Rather than treating XRP solely as a bridge asset for payments or liquidity provision, this initiative seeks to redefine XRP as an operational asset that can be actively used within financial workflows and contribute to revenue generation. It is important to clarify that yield reference in this context does not correspond to the community imagined DeFi style staking or speculative financial products. XRPL is not a proof of stake blockchain and does not include a native staking mechanism. Consequently, the protocol itself does not generate automatic yield. The yield envisioned in this framework is therefore based on external revenue derived from financial operations such as settlement, liquidity, provision, and market making, and designed to function entirely within existing regulatory and institutional boundaries. Several potential revenue sources can be identified. One example, use of the XRP ledger's native automated market maker, the AMM functionality, where spreads and liquidity provision fees generated through currency exchange could be allocated to entities that supply XRP inventory as part of the operational role. Another possibility involves sharing a portion of the cost savings achieved through on-demand liquidity-based settlement compared with traditional correspondent banking models, returning those savings as incentives to institutions that contribute inventory or operational capacity. Additionally, yield originating from fiat-based returns on tokenized money market funds or government bonds issued on the XRP ledger could, depending on regulatory design, be incorporated into XRP-mediated operational schemes. As such use cases expand, XRP is likely to become less of a purely speculative asset traded for short-term price movements and more of an operational inventory that may be held continuously to support ongoing business activity. Even though on-demand liquidity transactions and liquidity operations are instantaneous at the execution level, maintaining uninterpreted service requires a persistent reserve of XRP inventory behind the scenes. And now what we're hoping is things like this happen and more XRP is locked up in these specific use cases globally, reducing the available and circulating supply and raising the price. The resulting impact of price formation would not necessarily be characterized by rapid appreciation. Instead, structural selling pressure could be reduced, contributing to price stability on the downward side and a gradual transition toward a more mature market structure. This evolution can be seen as an important prerequisite for broader participation by institutional investors and corporate treasuries. This reduced sell pressure structure is also complementary to derivative usage models such as STXRP and MXRP. The STXRP involves locking XRP up for a defined period for collateralization or yield purposes while utilizing transferable receipts, whereas MXRP refers to institutionally managed XRP held under custody and contractual arrangements. Both mechanisms reduce incentives for short-term market sales when combined with SBI Ripple Asia's operational inventory strategy, contribute to gradual shift in XRP circulating supply profile and speculative to utility and collateral driven. That said, it remains important to note that the abrupt market changes could still trigger short-term selling due to collateral liquidation or redemption events. It is also worth emphasizing that this initiative differs in nature from digital asset treasury strategies such as those associated with Evernorth. DAT models focus on long-term holding of XRP as a balance sheet asset. In contrast, SBI Ripple Asia's approach prioritizes continuous operational use of XRP to enhance functionality and revenue generation. In simple terms, the former is a strategy of accumulating XRP, while the latter is a strategy of using XRP continuously. These approaches are not competitive, but potentially sequential and complementary, with operational use contributing to market stability that can later support treasury-oriented adoption. Taken as a whole, this initiative represents part of a broader shift towards reclassifying XRP not as a speculative price-driven asset, but as a financial infrastructure asset supported by regulation and real economic demand. In that sense, SBI Ripple Asia Doppler Finance concept can be evaluated as an important foundational step toward making institutional and corporate engagement with XRP a realistic, sustainable proposition. And so, just to kind of go through all of this, we did specify all this, but if you want to just read up on maybe some more simple terms on what all of this means, I will leave this on the screen here for you to do that. I did want to look at Japan here, what's going on with the carry trade. Japan's yen carry trade is an active but yet complicated unwind phase, with pressure building into December 18th and 19th. Bank of Japan meeting where another rate hike is widely anticipated. Markets are explicitly focused on further carries trade stress. The yen has strengthened moderately off the extremes. USD, Japanese yen, in trading around the mid 155s, and policymakers plus macro desks are now treating the carry unwind risk as a central scenario rather than a tail risk. The Bank of Japan has already shifted away from ultra loose policy and is now near a 75.75 policy rate, with the highest in roughly 3 decades, sharply narrowing the rate gap in the US and undermining the classic yen funding edge. The USD to Japanese yen has pulled back from the 160 zone and triggered a verbal and actual intervention threats earlier this year, and now trades around 154 to 156 band, reflecting some yen strength and growing expectations and further Bank of Japan hikes. Multiple macro shops and media outlets now describe the yen carry trade unwind as underway, with conservative estimates putting core levered positions in the hundreds of billions and broader yen-funded exposures in the low trillions. How far have we had in the progress of the unwind so far? Earlier 2025, an unexpected 25 basis point Bank of Japan hike triggered a violent mini unwind. The Nikkei futures dropped double digits in a day, VIX spiked in the 60s, and FX carry pairs blew out, providing how sensitive the system is. Since then, the Japanese bond yields have climbed significantly while yen spot stayed relatively weak, implying that a meaningful portion of the carry trade position survived and, in some cases, even grew as traders leaned back into the trade on the assumption of the gradual Bank of Japan. Current conditions are a classic late phase setup. Differentials are compressing. Options markets are starting to price higher early 2026 risk, and investors are slowly deleveraging ahead of potential shocks instead of a 2008 style capitulation. So here is a video kind of breaking some of this down too.
This is not a claim about what will happen. It is an explanation of why something like XRP exists at all. If countries such as Japan require flexibility without destabilizing global trade, the dollar needs a failsafe. XRP allows the dollar to remain the unit of exchange without forcing institutions to pre-fund and warehouse it everywhere. That reduces systemic risk without reducing dollar centrality. The old system worked because everyone pre-funded dollars. For decades, the US dollar remained dominant because oil was priced in dollars, global trade was invoiced in dollars, and banks around the world held large dollar balances in advance. These balances sat in nostro vostro accounts. This system functioned as long as foreign countries continued buying US assets, and holding dollars was not excessively risky or expensive. Japan was a key pillar of this arrangement. Now imagine Japan raises interest rates sharply. Suddenly, holding yen becomes attractive again, and holding dollars introduces FX risk. US treasuries are no longer the automatic default. Japanese institutions then face a practical question. Why are we warehousing dollars all over the world? This is not hostility toward the dollar. It is a response to balance sheet risk. This is where the old system begins to strain. The real problem is not the dollar, it is how the dollar is used. The issue is that the system forces institutions to hold dollars everywhere, all the time. That becomes dangerous when interest rates diverge, capital flows reverse, and large players like Japan require flexibility. This raises a central question. Can the dollar still be used globally without being pre-funded everywhere? This is where XRP and the XRP ledger come in. They do not replace the dollar. They change how the dollar moves. Instead of holding dollars in Japan, Europe, and emerging markets, the model becomes dollars remain where they are, and XRP bridges value only at the moment of payment. Settlement occurs in seconds. Long-term dollar hoarding is unnecessary. The same dollar can do more work with less risk. From Japan's perspective, flexibility is required, FX exposure must be reduced, and global settlement cannot be disrupted. The dollar is still needed for trade and energy. XRP allows this position. Dollar exposure can be reduced without breaking the dollar system. This is a pressure release valve. The petrodollar does not disappear, it evolves. Previously, it was a unit of exchange and a stored balance everywhere. In the newer model, it remains the unit of exchange, but is no longer a trapped balance sheet asset. Oil can still be priced in dollars, trade can still clear in dollars, and the US remains at the center of the system, just with less systemic risk and fragility. Counterintuitively, reducing the need to hold dollars increases the willingness to use dollars. That extends dollar relevance and buys time for the system to adapt. XRP supports the dollar by making it lighter to carry.
All right, and then here is a great follow-up. XRP price has the potential to explode. This is not based on random speculation or guesswork. I provide documentation for every last theory. A working theory on XRP price valuation, evidence from market infrastructures, the DTCC, SWIFT, and CLS, central banks and standards like the BIS, the IMF, the FSB, CPMI, and ISO 20022, US policy, Federal Reserve, etc., R3 Corda, BNY Mellon, and vendor connectivity, ACI, Finastra, CGI, Volante, Temenos, and TAS, all documented to be connected to Ripple and XRP. Why these estimates remain so conservative while outlining the valuation model is important to recognize that these figures remain conservative given the size of the existing financial infrastructure in which Ripple and XRP Ledger appear. For example, the DTCC alone clears about $3.7 quadrillion per year, according to the 2024 annual report. A single organization settling volumes that are already exceed the entire theoretical $1 quadrillion model commonly used in crypto valuations. This means the settlement landscape is far larger than retail investors assume, and many settlement rails that can capture even a fraction of these flows inherits a structural baseline value that far exceeds traditional crypto market capitalization logic. And so just getting down here to some of these prices, using the parameters provided, a fixed circulating supply of about 50 billion XRP, institutional settlement flows, and documented integration points. Estimates per XRP based on the percentage of flows routed through the XRP ledger: 1% 200, 2% 400, 5% 1,000, 10% 2,000, 14 2,800, and 25% $5,000. These figures arise from a quadrillion-dollar settlement environment, a fixed supply schedule, deep institutional integration, a burn-based deflationary mechanism, which really isn't something, XRP functioning as a neutral bridge liquidity, XRPL supporting tokenized debt, FX, stablecoin securities, and cross-border settlements. These projections are mathematically not speculative hype. So interesting to see, right? And they connect some more stuff here. SWIFT, NACHA, Federal Reserve, Royal Bank of Canada, US Bank, EBA, multiple clearinghouses, and of course, all the information I've shown you with the DTCC and R3, and just a ton of other information. I'm going to include this post down in the description. If you want to take a look at this and go into each one of these pieces, please do so. It's pretty well documented here. I thought this was going to be helpful to show you, but I'm really looking forward to seeing what 2026 holds for us XRP holders. And I am a buyer right now under $2. All right, guys, I'll see you in the next one. I'm Crypto Sensei. I'm going to go get some rest. I am beat. I'll see you guys. Aloha.